Hello and welcome to Mark My Words. This is Mark Homer. I'm going to do a Q&A today, which is comprised of questions from our listeners. Obviously things that people want to hear, so let's fire into it. So Dan asks, hi Mark, I've been enjoying your series of videos on your aspect building project. How is the project going? What have been the greatest challenges and what have you learned? So what's the main challenge been? Well, the main initial challenge was we started the project in sort of December 19, January 20. Within maybe 6 weeks, the main contractor went bust. So I took a team on and we've built the whole project ourselves in-house. So it's 121,000 square foot, 100 apartments, and we've been managing subcontractors. We've got lots of direct labour, buying materials, and we're now about 2 months away from completion. About half of the building has been handed over. I'd say over a third of the building is now let, and we're coming through to completion. Other big challenges would be sort of materials going up, although thankfully we got most of the subcontractors in contract before that happened. One of the subcontractors went bust, so we took all those men on and have bought those materials directly to finish off that package. We've had issues with a subcontractor being quite late and had an adjudication over that, which thankfully we came out the right side. But I'm told this is not uncommon for a site of this size and scale. Sam Knight asks, I currently have 2 other partners and we've saved up £20,000. Our plan is to open a limited company with a mortgage to buy a house for around 80k and add value with South Wales area. What type of house would you recommend to start with? I think the key really for me has always been little 2 or 3 bed terraces. Not the best areas, but certainly not the worst. So maybe sort of 1 or 2 steps up from the Bronx. You know, find the cheapest areas that you can, maybe with ex-council properties, or you know, stuff that you think will let well, but at the lower end of the scale. I mean, I guess in those areas you'll be able to get below sort of 80, 100,000 as you mentioned. The yield will be a lot better than buying something at 150. So yeah, I would probably, flats can be okay, but it's very much about the freeholder, what's the ground rent and the service charge. I've done better with terraced houses in the past. That's the sort of thing that I would continue with. You're planning to do most of the works yourselves as we are trades. Any advice is welcome. Well, you know, in terms of the refurb, you probably want more of a refurb so that you can buy the thing cheaper and utilise your own time and your expertise to get the cost of that down and to sort of control the other trades and make sure they're not getting ahead and make sure that their work is right. And I think you've got a big advantage there to get something that needs plenty of work, because the more work that is needed on a property, the gap between the sort of purchase price and what it will be worth once the works are completed, plus the cost of the works, is going to be greater, because people are going to need to price in the extra profit for somebody to manage all of those trades, probably a little bit of extra risk. If you're able to do a lot of these jobs yourself, then you want more and more refurb sort of type projects if you can do. Pedro asks, referring to the economy update video from the 5th of August, maybe correction but no crash. They are already taking measures to stimulate the economy, rising prices even more. Yes, they've taken a lot of measures. This was all largely done in the second quarter of 2020 last year. Interest rates went down to 0.1%. The quantitative easing program was extended. I think it's about 900 billion now. There was the furlough scheme, there were grants, there were bounce back loans, there were CBILS loans, and there were sort of discretionary grants at a local level. A lot of it was administered through business rates. So yeah, I think that's averted the immediate risk of a crash. Will there be a recession? Will there be a crash? Absolutely. I don't know when it is. I don't know when property prices will fall. They will inevitably do that at some point. But I'd say in the short term, the risk from coronavirus seems to have faded away. Lots of business people that I was talking to last year, including myself, thought when the furlough scheme came to an end, unemployment was going to go right up. Just doesn't look like that's what's going to happen. I think the Chancellor has managed the demand for staff and employees very, very well with the supply. In fact, it's gone the other way. There are lots of staff shortages. I went to try and get a pizza on Sunday, and there are big restaurants with hardly any people in there because of staff shortages. We've got the same at Progressive, and I think that is finding its way through all sorts of sectors and businesses at the moment. James Warren says, your dream car is, and what was your first car? I don't know, James. Yeah, what is my dream car? I probably don't have one. It moves around. I think the best sort of sounding car and one of the best looking cars is a Lamborghini Aventador, which Rob and I bought a few years ago. We have an Ariel Atom, which I absolutely love thrashing on the back lanes. I took that out a bit this weekend. It's supercharged and it's so quick. I have a lot of fun in that. And I sort of drive a 911 for daily use. It's pretty incognito. I can get around without people looking at me. I can go and do my business without getting harassed, which is of great value to me. So that's what I use for most of the week. But yeah, I don't know, sort of, I suppose your dream type machines are things that you don't have. I love that Porsche 918. That's very cool. Mercedes 300 SL, the Gullwing, that's amazing, but they're €1 million. I love the Pagoda. Again, that's an old SL from the 70s, a 280. They're probably stabilised. I'll probably end up getting one of those. That's very cool. I love the restored versions of those, the Hemmels do. Yeah, that's. I tend to try and buy things now that don't drop and don't depreciate, and then I don't feel compelled to be switching in and switching out. And I like sort of new technology and the electronics and all that sort of stuff, but I'll probably just limit that to my sort of daily driver as I move forward, and the other stuff I have will hopefully be non-depreciative and hopefully go up. I quite like older stuff, classics that have already sort of dropped in value and are becoming sought after again. Judy asks, if you couldn't invest in stocks or property, what would you invest your cash into? It's a very good point, Judy, because of course equities, stocks and property are what I do, with most of my money. Watches can be good as long as you buy the right type. So sort of Rolex sports watches, maybe Submariner Anniversary, where they're limited supply, or maybe a Daytona with the steel Daytona, Rolex steel Daytona. They're good. Maybe if you buy sort of Audemars Piguet, the right models, the limited supply ones, maybe the Byblos or a Terminator. Some Pateks can be very, very good. The Nautilus has obviously performed really well, but they're plenty of money now. So I think if you buy the right watches that are, controlled in their supply, they can be a good investment. Other investments, I suppose Bitcoin's probably here to stay, and that's probably a good thing. I wouldn't put a massive amount of my wealth, maximum 5%, into something like that, because you could see big swings up, but you could see big swings down, and it could go to zero. You never know. So, I think they're my sort of main, I suppose, precious metals. Maybe buy some physical gold, but I wouldn't put too much in there. There's no income stream. If you look at the way prices have gone with gold and silver over the last, since I've been looking the last sort of 10, 15 years, yeah, they've been pretty good, but they don't match equities or property when you look at the overall return, nowhere near. They're just a good hedge, a good sort of counterbalance to sort of property and equities. Lloyd says, hi Mark, your books are better than Rob Moore's. Thank you, Lloyd. When are we getting a new book from yourself? Oh, that was a way to get me to write a new book. Not sure. To be fair to Rob, on both of my books, he kicked my arse to get them done. On one of them, he sat there and typed it out and I sort of spoke it. Yeah, wait and see, Lloyd. It's pretty painful for me. So I have to have a few years in between each one. Julie says, in an alternative universe, you never became a property investor. What do you think you would have been doing? Julie, when I was at school, I always wanted to be a pilot, and I probably didn't get the grades I should have done in maths and physics, so I thought that dream was over. The British Airways sort of pilot cadet scheme required good grades in maths and physics, and the RAF was the same, so I sort of gave that dream up. So yeah, I would love to have been a pilot. I think I sort of quenched some of that thirst by passing my PPL helicopter test. So I fly a small helicopter sometimes, and I've just started again last week. I'm just doing the proficiency check to renew my license at the moment. When I was young, I always wanted to be an investment banker. I'm not sure that, probably because of what they earn, I'm not sure that would have been the best choice, looking at sort of how many hours they work versus what they earn and sort of lifestyle sort of balance. I'm not sure that would have been the best, but yeah, could have been interesting. Graham says, what's the funniest story from the early days of progressing and working with Rob? Oh man, God, there's been all sorts of stuff. I'll have a think about that, Graham, and I will come back to it. Kevin, it's so difficult to invest in Scotland now. They've added additional taxes, which makes it so bloody hard to acquire your second and third property. Bloody joke, any advice? Kevin, it's the same in England. They've added stamp duty on. You can't offset all the mortgage interest against the rent unless you're in a limited company, and clearly the taxation within limited companies is more than it is personally or within a partnership. I still invest. I still think it's great. The returns are so much higher. You know, I just think you've sort of got to crack on and suck up those extra taxes or invest in a limited company, and you'll avoid Section 24. With the stamp duty, I don't think there's any way around it. I mean, I've purchased often commercial buildings and converted them. That gets around some of the stamp duty, but clearly I'm involved in a huge project which takes a load of my time, and there's a load of other costs that come with it. So you could use multiple dwellings relief to reduce the stamp duty on a block of flats somewhat, but I think in the main you've got to suck it up and pay it. Nikita said, Mark, you use an external company or accountant to manage all your finances, or do you do this yourself? So yeah, I mean, in terms of our year ends and our personal tax returns, we always have an external firm of accountants file these for us. You know, it's too complicated for me to do them myself, and I get a load of advice and tax information and stuff that I can use in our businesses. So I think we use 3 firms of accountants for our different businesses and, you know, our personal returns. So I'm constantly talking to them, getting new ideas, new advice, and internally we have, I think, about 10 finance staff who compile management accounts and put all the information onto Sage so that the year ends can be filed and all the VAT returns go in. So, you know, we have a sort of mix of internal and external accountants that look over all of these different businesses. Jay said, love your podcast and YouTube videos, Mark. Renting to tenants with pets, what's your thought? Jay, you know, we do rent to tenants with pets. I think the rule is if they pay to have the carpet and the interior cleaned before they leave, then they can bring a pet. But it does depend what it is. You know, a sort of small, medium dog's okay. A massive German, hairy German Shepherd probably isn't. And often, tenants will be asked for a bigger deposit because the dog may sort of chew up, timber and, door frames and all that sort of stuff. So, we're quite cognizant of that. Mark says, what's the best advice you've been given? Some of the older boys, talk a lot about sort of keeping cash back, don't over leverage. Obviously, they remember the high interest rates of the late 80s, in the 90s. We're in a different place now. Asset values are way higher, so we couldn't, there's no way the economy could stand interest rates of 8, 10, 15%. Most of the country just go bust. So, if we do go back there, it will take many, many years. Good advice is definitely over the long run, why would you over leverage? I'll usually take the loan initially up to maybe 70, 75%, but over time, I'd look to let those drift down to 50%. Another good sort of piece of property advice is always, keep liquid, keep plenty of other alternative investments back, which could be cash or could be equities. You certainly don't want to put too many of your eggs in one basket, and that leads on to having multiple income streams. And that is probably, if you could crystallize all the best advice that I've had, having multiple income streams is critical, at least 3 or 4. Try and make them as unrelated as possible. For instance, we have a letting agency, which we get income from. This training business we get income from. Our property portfolio we get income from. We have a sort of franchise networking business we get income from, and some other sort of interests as well. The reason to have them coming from different sources is because you don't know when a pandemic's going to come along and you're going to have to shut a training business down, and effectively you can't run a line of events, but your property portfolio probably does quite well and your letting agency does quite well. You don't know when a credit crunch is going to come along, and a training business can continue and probably thrives, but your property portfolio may be adversely affected because banks may demand money back. You may have to suddenly find cash quickly, and you may find it hard to remortgage. If you're running a property sourcing business, as we were at that point, you might find the income reduces in that business. So, there's always a different sort of black swan event. You can't predict what it's going to be. Another recession comes along the time before, which I wasn't really conscious for in the late 80s, early 90s. Interest rates went very high. You had MIRAS, where mortgage interest relief was removed by the government. And you had the ERM crisis, which was the European exchange rate mechanism, which was what pushed interest rates so high. Looking at our businesses here, our letting agency and our property portfolio would have probably been quite badly affected with such an increase in interest rates. However, as property values go down, the rental business would have prospered. So we'd probably done quite well on the rent, but the values of our properties would have dropped significantly. If we've got to do any remortgages at that point, or we were halfway through a project that had got to be refinanced at the end, or if some of the banks said we'd breached our covenants, we may have to put a big dollop of money in to bring the loans down to get back into covenant. That during that period, that side of the business wouldn't have been very good. The training business probably would have done very well. So each recession, each downturn has a different set of ingredients, so a different cake is baked, and therefore you don't know quite which income stream is going to do better and which one might stop completely or which ones might stop completely. So the point is you want to have lots of them across multiple different types of businesses. Yeah, they need to be related because you need to understand them, but within your circle of, or within your sphere of competence, you want to be setting up and having income streams from different businesses that are as unrelated as possible. So when the next issue comes along, some of your business is not effective and the income can carry on. And clearly you don't want to be spending all of your income. You want to be saving a good chunk of it so that you don't end up in bother when these things come about. JJ says, what are the pros and cons of repayments or interest only? What do you do and why? Okay, so I get this question a lot, and there isn't a simple answer, JJ. It's very much dependent on the whole deal that I'm going to get from a bank. If all things being equal, if I was being offered 2 loans from 2 banks and the interest rate was exactly the same, I would choose the interest only option. Because, and let's say they were both fixed and all the other terms were the same. The reason I would do that is because, generally speaking, property values over the long run rise at about 5% per annum. So they probably double about every 15 years if you look back. I know it might have been a bit more than that, during certain periods, and at the moment it probably is. Well, it's probably gone up 10-15% in this area over the last year, but that won't continue. It probably comes back to the mean, the average sort of 5%. So in, I don't know, 10, let's just say in 30 years' time, you can see the value of that mortgage will be much, much lower in comparison to the value of the property. In addition to that, inflation erodes the real value of your mortgage. So if inflation at the moment, I think it's running in the 2s, maybe 3%, the actual mortgage balance, if it was 100,000 when you started, at the end of the year, if you've got 3% inflation, the real value of that mortgage, even if you haven't paid it down, is 97,000. And the rent, you will get the extra money through the rent because inflation will push the rents up, as we're seeing again now. So over time, inflation will pay your mortgage down. I always think of the example of my uncle, who back in I think maybe the 70s, he bought his house. He had to go on a repayment mortgage. It was the only option back then on a residential mortgage, and it pretty much is again now on a residential mortgage, not a buy-to-let mortgage. And back then, he paid his mortgage every month. Let's say it was a £3,500 mortgage on his house, and let's say his mortgage was £150 a month. So that sort of £100 of it was the interest, and £50 a month was the repayment portion. And let's say at the end of the 30 years, if we rewind, when he started, he had his £150 a month mortgage payment. That extra 50 quid, the repayment portion, probably meant they had to do without, I don't know, going out for dinner maybe once or twice a week, or maybe it meant they couldn't go on holiday quite as often. It definitely had an impact on their daily life. If he had had the option of going interest only and paying £100 a month, he could have had those extra couple of dinners and maybe gone on holiday more often, and because £50 was worth a lot more back then. Then 30 years later, his mortgage would still have only been £3,000, £3,500, whatever it was when he started, and he could pay that off with one paycheck 30 years later, because inflation has eroded the value of the mortgage and his wages have gone up, at or above the rate of inflation. 30 years earlier, he was probably only earning, let's just say £300 a month. So the mortgage was a big chunk of it. If you fast forward 30 years ahead, or 30 years into the future, his monthly salary was probably about £4,000. So he could have paid off that whole mortgage with one paycheck 30 years later. So that's a sort of a good example there as to why interest only works. That said, you don't want to over leverage, and I think over time you want the loan to value to drift down. Let Father Time pay it off. My long-term sort of goal is 50% loan to value over the portfolio. Yes, I leverage up initially, but let it drift down, let inflation pay it down. But what I have found often, JJ, with repayment mortgages, certainly with one of the banks that we use, if we go to, say, Lloyds, Barclays, Santander, one of those big clearing banks, you can often get mortgages in the sort of 2.5% range. Lloyds will probably do me track a investment loan in that sort of zone, as long as I'm borrowing sort of £500,000 plus. And you could do that if you package up a few properties together. Almost always they will insist on repayment. Now it's not, it's 25-year repayment, so that's the profile. It's not sort of draconian, but you are repaying it. If I look at some of the challenger banks and the interest only sort of hybrid type lenders, I don't know, maybe Shawbrook, Aldermore, those types. Often if I went to them and asked for a loan, they'd be asking for more like 4, 5, some of them 6%. So if I look at the actual payment, it's probably about the same. If you took those two scenarios. Yeah, the loan to value may be slightly higher with the sort of Shawbrook, Aldermore type option. I don't know, maybe you could look at Kent Reliance or maybe sort of Synergy or those type lenders. Yes, the loan to value is maybe slightly higher, but the payment's probably about the same. The difference is the Lloyds loan or the Barclays loan or the Santander loan or the RBS loan won't be there in 25 years. You'll have nothing, whereas the loan will still exist with the other lender. Diana says, where is a good place to invest in the UK with 40k cash? You could buy in lots of areas, Diana. You could buy a sort of 3-bed ex-local authority terrace. I would say anywhere north of Peterborough, really. Maybe 150,000, 160,000, 170,000. Put the deposit in, refurbish it, try and get it as cheap as possible, then remortgage it. Maybe you get 20 grand out to go towards your next purchase. Flats can be okay, but maybe more when the freeholder is ex-local authority or reasonable. You don't want to be buying ones with sort of private freeholders who are going to fleece you. So I'd try and stick to the little sort of 2-3 bed terraced houses. The further you go north, the further that's going to go, and into Scotland. You could buy houses in Middlesbrough for 30 grand. You probably don't want to buy in those streets because you're going to have issues collecting the rent, and maybe they'll get stripped to the boiler and the copper pipes. But there are houses in those areas you could get at 50, 60,000 that will work really well and yield double digits, 10, 11, 12% plus. Corby's the cheapest place close to here, but there you're probably still looking 3 beds at 140,000 cheapest. So yeah, cheap areas, lower capital values equals higher yields, which means that those are the areas where it's easiest to remortgage more of your cash out, and you end up with more cash flow. So they're the areas I like. As long as they're solid rental areas, I can get good private tenants who want to stay. Just rewinding, I had a question about the most crazy moment since we've been at Progressive, and I would say, obviously it's sort of recent memory, but it probably was the pandemic. Being told by the government that we'd got to shut our events business was crazy. I never envisaged it. It was the perfect example of the black swan. We're not completely out of the woods with coronavirus yet, but those were pretty serious times. We had to move everything online. All the staff went home. Lots of other industries had sort of similar issues, but clearly a live events business is very difficult to run from your living room. So that was crazy. Hope that has been of value to you. Hope you've got some good information from that. If you've got more questions, send them in, and I'll do another one of these podcasts and videos to hopefully enlighten you further. That has been Mark Homer for Mark My Words.